Ever wonder how Warren Buffett, one of the world's most successful investors, handles his dividends in today's market? Buffett, often hailed as the Oracle of Omaha, didn't just stumble upon his fortune. His journey to becoming one of the wealthiest individuals on the planet is a tale of perseverance, strategy, and smart investing. From his early days trading stocks while still in high school to his transformation into a billionaire investment guru, Buffett's story is nothing short of inspiring. His knack of picking out profitable investments and his unique approach to dividends have proven time and time again that he truly is the master of financial games. Now let's dive into Buffett's ingenious dividend strategy. Firstly, we need to grasp the basics of dividends. Picture dividends as slices of companies' earnings given out to shareholders. It's a way for companies to share their success with those who have vested in them. These payouts usually occur quarterly and can be an enticing form of passive income. Now imagine you're at a buffet and you can have an array of foods to choose from and some healthier than others. This is similar to the world of dividend investing. Not all dividend-paying stocks are created equal. It's not just about picking a company because it pays a dividend, but rather it's about choosing the right company that has the potential for long-term growth and stability. Enter Warren Buffett's approach to dividend investing. Unlike a regular diner at a buffet, Buffett doesn't just pile on his plate everything in sight. Instead, he's selective, choosing only the best quality ingredients, or in this case, companies. He looks for businesses that are not only profitable, but also have a competitive advantage, or a moat, as he calls it. Buffett's strategy focuses on companies that consistently pay dividends, indicating a strong financial health. He also favors those that have a history of increasing their dividend payouts, displaying their ability to grow and adapt in an ever-changing market. However, it's important to note that Buffett doesn't just rely on dividends for his investment returns. He is a firm believer in the power of compounding. By reinvesting his dividends back into more shares of the company, he's able to exponentially grow his investments over time. But here's the catch. This strategy requires patience and a keen eye for detail. It's not about chasing the next big thing, but rather it's about understanding the value of a company and its potential for long-term growth. In conclusion, Buffett's strategy is not just about picking any dividend-paying stock. It's about choosing quality over quantity, consistency over sporadic growth, and patience over quick returns. Truly a buffet of wisdom from the Oracle of Omaha himself. Buffett doesn't just pick any dividend-paying stocks, he has a specific criteria. Now let's delve into exactly what these criteria are. First and foremost, the company must have a competitive advantage or economic moat, as Buffett likes to call it. This means the company has a unique attribute that sets it apart from its competitors, making it difficult for others to replicate their success. It could be a strong brand, cost advantage, or proprietary technology. This economic moat protects the company's profits and allows it to sustain its dividend payments. Next, Buffett looks at companies' management. He prefers companies run by competent and honest leaders who are committed to acting in the best interest of the shareholders. They should have a track record of making wise decisions and have led to steady growth and profitability. Thirdly, Buffett considers the company's financial health. He scrutinizes financial statements for consistent earnings, low debt levels, and strong cash flow. Companies with these characteristics are likely to maintain and increase their dividends. Finally, the price of the stock matters. Buffett seeks to buy stocks when they are undervalued. That is, when the market's price is less than the intrinsic value. This provides a margin of safety and increases the potential for higher returns. These criteria, a competitive advantage, good management, financial health, and a reasonable price form the cornerstones of Buffett's strategy for picking dividend stocks. And it's not just about picking the right stocks, it's about picking them at the right time. But how does he decide when to buy the stocks? Buffett doesn't buy stocks on a whim. He has a well-calculated buying strategy. When it comes to buying stocks, Warren Buffett isn't your average Joe. His strategy is meticulously crafted, one honed over decades. So what's this magic formula? Well, it's not magic at all. It's about finding undervalued companies and holding on to them for the long haul. But how does he find these undervalued stocks? It's a combination of thorough analysis and intuition. Buffett looks at the intrinsic value of a company, which includes factors like its financial health, industry position, and potential for growth. He then compares this with the current market price. If the intrinsic value is significantly higher than the market price, it's a potential buy. He's not swayed by market trends or short-term fluctuations. Instead, he focuses on the long-term potential of a company. This is a bit like buying a house. You don't buy a house because the price dropped this week. You buy it because you believe it's a long-term value. But Buffett's strategy doesn't stop at buying. He also believes in holding on to his investments. In fact, he famously quoted as saying, "Our favorite holding period is forever." This is because he understands the good companies usually increase in value over time, and selling too soon could mean missing out on potential profits. So when does Buffett sell his stocks? Well, that's a good question. The truth is, he rarely does. Buffett's strategy is all about buying and holding. He only sells when a company's fundamentals change drastically, or if he finds a more attractive investment opportunity. But of course, this strategy is easier said than done. It requires a deep understanding of the market, financial analysis skills, and above all, patience. But as Buffett's success shows, it can certainly pay off. All right, folks, we dove into some fascinating insight about Warren Buffett and his dividend strategy. But the discussion doesn't end here. Hit the thumbs up button if you found this video enlightening, and make sure to subscribe for more engaging finance and economic content. Your support fuels our journey in bringing you valuable insights. Let's keep this conversation rolling. Selling stock is just as important as buying them in Buffett's dividend strategy. The Oracle of Omaha, Warren Buffett, is known for his long-term investment strategy, but even the most patient investor has to sell at some point. So, when does Buffett decide it's time to let go? Buffett's selling strategy is quite straightforward and yet profoundly wise. He holds onto his stocks as long as the company is performing well and meets his investment criteria. This means as long as the company's fundamentals remain strong and it continues to deliver consistent returns, Buffett is in no hurry to sell. But what happens when the company's performance deteriorates? Buffett's selling strategy kicks in here too. If a company starts to falter, if its earnings drop, or if it's no longer aligned with his investment criteria, Buffett doesn't hesitate to sell. He believes that it is better to exit a sinking ship than to go down with it. Now here's where it gets interesting. Buffett also sells when a stock is overvalued. Yes, you heard me right. Even if the company is performing well, but its stock price is higher than intrinsic value, Buffett considers selling. He believes that overpriced stocks often correct in their fair value and is better to sell before this correction happens. This might seem counterintuitive. After all, why sell a stock that's performing well? But remember, we're talking about value investing here. And for Buffett, the price you pay for the stock is just as important as the value you get. If the price is higher than the value, it's time to say goodbye. So to sum it up, Buffett's selling strategy revolves around three key factors: the company's performance, its alignment with the investment criteria, and the stock's valuation. It's a disciplined and thoughtful approach that helps him maximize his returns and minimize losses. But Buffett's strategy is not just about buying and selling stocks. It's about understanding the value, being patient, and making informed decisions. And that, folks, is the secret to his success. Reinvestment is a crucial part of Buffett's dividend strategy. Now let's delve into the heart of this strategy, the reinvestment process. When dividends start trickling in, what does Buffett do with them? He doesn't splurge on beach vacations or buy a flashy new car. No, he reinvests those dividends, plowing them back into the market for the seeds of tomorrow's profits. This reinvestment can take two primary forms. First, Buffett might buy more shares of the company that paid the dividends. This is a classic strategy, compounding the power of his initial investment. Over time, it's like a snowball rolling downhill, gathering size and speed. You start with a small investment, reinvest the dividends, and before you know it, you've got an avalanche of wealth. But Buffett doesn't just limit his reinvestment to the company that paid the dividend. He's always on the lookout for other promising stocks. If he sees another company that meets his criteria, strong fundamentals, good management, and a fair price, he might use his dividends to buy shares in that company instead. This approach helps him diversify his portfolio and spread out his risk. However, it's essential to remember that this isn't a way to make a quick buck. Reinvestment requires patience and discipline. It's about playing the long game, waiting for the magic of compound interest to work its wonders. It's about understanding the market, doing your homework, and making smart, informed decisions. Buffett once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." Reinvestment is about planting those trees, nurturing them, and waiting for them to bear fruit. As you can see, Buffett's dividend strategy is not a get-rich-quick scheme. It's a thoughtful, deliberate approach to building wealth over time, and it's one that has served him and could serve exponentially well. Patience is a virtue, and in Buffett's case, it's a profitable one. Now, let's talk about the role of patience in the investment world, particularly in Warren Buffett's dividend strategy. Often, when we think about investing, we picture fast-paced trading floors, quick decisions, and overnight millionaires. But that's not the way Buffett plays the game. For him, investing is not a sprint, but a marathon. It's about the slow and steady accumulation of wealth over time. In the context of his dividend strategy, patience means holding on to stocks for years, sometimes even decades, to reap the benefits of compounding dividends. It's about resisting the urge to sell when the market dips and instead holding firm to the belief that good companies will bounce back and continue to generate profits. This isn't always easy. It requires a strong stomach and a long-term perspective. But the patience has paid off for Buffett in a big way. Many of his most profitable investments, like Coca-Cola and Apple, were held for many, many years before they started to produce significant dividends. But there's more to patience than just waiting. It's also about carefully selecting the right companies to invest in. Buffett doesn't jump on the latest hot stock or trend. Instead, he takes his time to thoroughly research potential investments, ensuring that they meet his stringent criteria before he takes the plunge. So you see, patience isn't just about waiting. It's also about making thoughtful, well-informed decisions. It's about having the courage to stick with the investments, even when the market gets rough. And most importantly, it's about understanding that building wealth takes time. So what can we learn from Buffett's dividend strategy? Patience, my friends. Patience. It's not just a virtue, it's a strategy. And as Buffett has shown us, it's strategy that can pay off handsomely in the long run. Warren Buffett's dividend strategy offers valuable lessons for all investors. As we come to the end of our journey, let's take a moment to reflect on the main takeaway from the investment approach. Firstly, Buffett's strategy emphasizes the importance of picking strong and reliable dividend-paying companies. It's not just about the highest yield, but a consistent and growing dividend payout. It's about companies that have stood the test of time, companies that have a proven track record of profitability and an enduring competitive advantage. Secondly, Buffett's approach underscores the value of patience, investing in long-term game. It's not about timing the market, but time in the market. It's about letting your investments grow and compound over time. Remember, Rome wasn't built in a day, and neither is a robust investment portfolio. Thirdly, reinvesting dividends is a central part of Buffett's strategy. It's about using the power of compound interest to accelerate the growth of your investments. It's about letting your money work for you and letting the returns from that money work for you as well. Finally, Buffett's strategy teaches us the importance of discipline. It's about sticking to your investment plan even when the market is volatile. It's about being able to resist the temptation to chase hot stocks or panic sell during a downturn. So, what can we learn from the Oracle of Omaha? It's simple. Invest in strong dividend-paying companies, be patient, reinvest your dividends, and stay disciplined. No matter where you are in your investment journey, these lessons can help you navigate the often turbulent waters of the stock market. Remember, investing is not about getting rich quick. It's about growing your wealth steady over time, just like Buffett. Thanks for joining us on this exciting exploration journey into Warren Buffett's top dividend strategy for today's market. If you've enjoyed the ride and want to continue exploring financial-related topics with us, make sure to like, subscribe, and hit the bell icon for notifications. We hope you gained valuable insights and had a great time learning with us. Keep on expanding your knowledge and stay tuned for more fun financial insights. See you in the next video.